Welcome back to Part B of our Topic 9 lecture. We will start this part of the lecture by discussing Learning Objective 3. Here we'll explain the essentials of a single audit, and that includes the purpose and scope of a single audit, major program identifications, audit work required, and the reports that must be submitted. Let's start with a bit of a history of the Single Audit Act. It was prior to 1979 when each federal agency conducted its own audit based on grant-specific requirements. Just to give you a bit of a context, federal government in aid to state and local governments are in the billions of dollars, not just millions, but billions of dollars. And it's in the vicinity of about $650 billion annually. So these grants originate from more than 1,000 programs administered by more than 30 federal government departments and agencies in the United States of America. Now, a great majority of these grants in aid came from 5 departments. About 60% comes from the Department of Health and Human Services. The rest comes from the Department of Transportation, the Department of Education, the Department of Agriculture, as well as the Department of Housing and Urban Development. So until the mid-80s, each federal agency established their own accounting, reporting, and auditing requirement for each program administered with the government grants, and as you can imagine, each of these would be different from agency to agency. So the amount of time spent keeping track of conflicting requirements and providing facilities for succession with different groups of auditors became just too troublesome. And therefore, there has been a drive to standardize grant accounting, reporting, and auditing requirements from around the late 60s. So that was prior to 1979. Now, because all these standardization attempts were not really achieving the success that the government wants, in 1979, the Office of Management Budget required federal audits to be done on an organization-wide basis rather than grant-by-grant basis. And that is what we are referring to as single audit. In 1984, so it's only towards the mid-1980s, that the Single Audit Act was passed. So the Single Audit Act of 1984 was passed to facilitate organization-wide audits of federal funds. It was amended and revised in 1996, 1997, 2003, and again in 2013. So the current guidance for single audit is contained within an OMB, the Office of Management Budget document titled Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. The purposes of the Single Audit Act are actually fourfold. So the first one is really to improve the financial management of state and local governments with respect to federal financial assistance programs. So second is to establish uniform requirements for audits of federal financial assistance provided to state and local governments. Number 3 is to promote the efficient and effective use of audit resources. And the fourth is to ensure that federal departments and agencies rely upon and use audit work done pursuant to the Single Audit Act. So a lot of this is driven by the desire to establish uniform requirements for audits and of course to improve financial management and make it more efficient and effective. So who must have a single audit? Before we start who should have single audit, let us have who must not have. All right? So non-federal entities that expend less than $750,000 of federal awards during the fiscal year generally are exempt from federal audit requirements for that year. So remember that single audit is a federal audit requirement. So if you are a state and local government that expend less than $750,000, then you don't necessarily have to have a single audit. So let us now answer the question, who must have a single audit? First question is, are you a state or local government or not-for-profit organization? So are you a non-federal entity? If your answer is yes, then the next question is, have you expended at least $750,000 in federal awards during the year? If the answer is no, then there's no need for single audit. You can just comply with any non-federal audit requirement. All right? So, but if you answered yes to the $750,000 expenditure threshold, then the next question is, have you expended from only one program or program cluster? If the answer is no, then perform either a single audit or a program-specific audit. If it's a no, then you have kind of a choice between single audit or any program-specific audit. But if you answered yes, all the $750,000 is expended for one program or one program cluster only, then definitely you need to perform a single audit. By the way, it is important to note that this $750,000 threshold is based on federal awards expended rather than received. All right. So some typical examples of expenditures would be incurring labor costs, purchasing or using supplies, paying utility bills associated with the grant, the federal grant. So cost reimbursement contracts, cooperative agreements, and all that will be considered as expended. All right, so it's not the grant received, but the grant expended when we are deciding on the $750,000 threshold. All right, so what are the single audit requirements? We've mentioned at the beginning of the lecture that single audit has kind of a more complex standard of audit compared to GAS and GAGAS. So what are the requirements for single audit? Number one, an annual audit must be performed encompassing the non-federal entity's financial statements and schedule of expenditures of the federal awards. So that's part of it. Number two, the audit must be conducted in accordance with generally accepted government auditing standards, so GAGAS. So you can't choose between, should I use GAGAS or GAS? When you are a single audit, you have to abide by GAGAS, all right? And it should cover the operations of the entire non-federal entity. So it could be the entire state or the entire local government. Number three, the auditor must determine whether the financial statements are presented fairly in all material respects with GAAP and whether the schedule of expenditures of federal awards is presented fairly in relation to the financial statements taken as a whole. All right. And the fourth, for each major program, the auditor must obtain an understanding of the internal controls pertaining to the compliance requirements for the program, assess control risk, and perform tests of controls unless the controls are deemed to be ineffective. So in the next slide, we will be looking at compliance as well as what do we mean by each major program. Let's start first with compliance audits. In the uniform guidance, it requires that auditor should express an opinion that the auditee, the audited government agency, complied with laws, regulations, and grant or grant provisions that could have a direct and material effect on each major program. In order to gather sufficient evidence, the auditor need to test whether each major program was administered in conformity with administrative requirements contained in the uniform guidance and compliance requirements contained in the compliance supplement. In illustration 11-8, it shows a sample matrix of compliance requirements. You will see here the CFDA. CFDA simply means the catalog of federal domestic assistance. So the first column here is actually showing the CFDA title and number of each of the federal domestic assistance projects. All right, and this is where the auditor is looking at whether each major program was administered in conformity with the administrative requirements as contained in the uniform guidance and compliance supplement. So it says here for each, all activities, for example, in column A, all activities allowed or unallowed. Yes, Y for yes, and N for no. Allowable costs, Y, as you can see there. And then in other columns, you've got the different items such as equipment and real property management, eligibility, matching level of effort, earmarking, and the like. And the auditor states whether it's a Y, yes, and a no, N. So Y is yes, this type of compliance requirement may apply to the federal program, and N, no, the program normally does not have the activity requiring the auditor to test this type of compliance requirements. So this is just an example of how the auditor administers this uniform guidance and compliance requirements. Now, what are the auditee requirements? Well, whilst the auditors have requirements and ensuring that compliance audits are adhered to, auditees have the requirements, firstly, to identify all federal awards received and expended, and the federal programs under which they were received. So it is the auditee's job to maintain the catalog of federal domestic assistance, CFDA. Also, the auditees prepare the financial statements and the schedules of expenditures of federal awards. They need to ensure that audits are properly performed and submitted when due, and they'll need to do follow-up and take appropriate corrective action on audit findings. On top of that, they also need to maintain appropriate internal controls and systems to ensure compliance with all laws, regulations, and contract or grant provisions. Let's move on to this risk-based approach for selecting major programs for audit. Remember the term major programs. What do we actually mean by the term major programs? Well, major programs are all federal programs identified by the auditor through a risk-based process that will be audited as part of a single audit. So there is supposed to be a risk-based analysis that needs to be conducted in order for us to identify the major programs for the audit. Illustration 11-9 is showing us the risk-based approach for selecting major programs for the audit. In the first step, we are looking at identifying Type A programs. These are the larger federal programs that are major because of these amounts of expenditures. There is a scale that we need to use. The threshold for Type A program depends on the total award expended. So, if the total federal award expended is between $750,000 to $100 million, the threshold for Type A program would be the larger of $750,000 or 3% of the total federal award expended. So how do we apply this? If we are at the lower bracket, $750,000 is awarded to a state, and this $750,000 only goes to one program, then that means that one program is a Type A program, all right? Because it's $750,000. Now, if, for example, the federal agency awarded $100 million to a state, and the amount of, let's say, one program was for $750,000 out of the $100 million. Is that considered a Type A program? Well, the answer is no. Why? Because it's the larger of $750,000 or 3% of the total federal award expended. 3% of $100 million is what? It's $3 million. So the larger of $750,000 and $3 million is $3 million. And the program only was given $750,000. So that program is not a major program because it does not meet the Type A threshold. But if one program was given $3 million and $100, so $3,100,000, is that a Type A or a non-Type A program? Well, it is a Type A program because the full amount of the award is $100 million, 3% of that is $3 million, and this particular program received $3,100,000 is bigger than 3% of the total award expended. Now, if the total award expended is between more than $100 million to $10 billion, the threshold for Type A program would be the larger of $3 million or 0.3% of the total federal awards expended. So, if your total award is for $10 billion and one program received $750,000 or $1 million or $2 million, those programs will be considered non-Type A. They will only be considered Type A if they are at least 0.003 of 10 billion amount. So 10 billion times 0.003 is 30 million. It's the larger of 3 million or $30 million. A project that has award of $30 million will be considered a Type A program. All right. So step one is to identify larger federal programs and analyze them as Type A or Type B programs. So if the program did not satisfy the Type A threshold, then they are Type B. All right. So what's step two? So step one is to identify Type A. Then step two is to identify low-risk Type A programs. So what are low-risk Type A programs. These are the programs previously audited in at least one of two most recent audit periods as a major program, with no internal control deficiencies identified as major weaknesses, no opinion modifications, or any significant question costs in the most recent audit period. So programs with no significant changes in personnel or systems that would have significantly increased risk, and programs that in the auditor's professional judgment are low risk will be considered as low-risk type A programs. So there is that term professional judgment. So there are certain cases whereby the auditors will have to use their professional judgment in deciding whether a type A program is considered low risk. We had looked at the first two steps in this slide. Let's now look at the last two steps. So step 3 is to identify high-risk type B programs. So based on the auditor's professional judgment and criteria, some type B programs might be considered high risk. Now, the auditor is not expected to perform risk assessments on relatively small federal programs. So the risk assessments are performed only for those type B programs that exceed 25% of the type A threshold determined in step 1. Now in step 4, this is where at a minimum the audit must be done for major programs of all type A programs not identified as low risk, and all high risk type B programs totaling at least 1/4 the number of low risk type A programs identified as low risk in step 2. Now that's quite a mouthful, but it's pretty much like this. The auditor will focus on type A and also some of type B programs that are considered high risk. Now there may also be some type A programs that are considered low risk, so the focus really is on type A high risk and type B high risk. All right, any type A that is low risk can still be excluded or not become the focus of the auditor's attention. All right, now in applying the percentage of coverage rules, all right, what's the requirement? So the percentage of coverage rules requires the auditing of as many major programs as necessary to ensure that at least 40% of the total federal awards expended are audited. So if we are talking about $100 billion worth of federal grants, we need to be able to at least audit about $40 billion worth of federal awards. And we will follow it in the priority of type A programs first that are not considered low risk, then type B high risk programs. All right. So in addition to the possibility of reduced audit coverage resulting from individual type A programs being classified as low risk, the uniform guidance also provides that the auditee itself can be classified as low risk and therefore receive even greater reduction in audit coverage. So obviously there is a cost to audit. So the auditee would like to minimize the cost as much as possible. And so that's the reason why there is this risk-based approach for reduce the cost of auditing. So what are the reports required for single audit? Well, the auditors will have to have the auditor's reports based on, of course, the financial statements and schedule of expenditures of federal awards, the summary schedule of prior audit findings, and the corrective action plans, including the auditor's reports. All these 4 documents must be submitted electronically to the Federal Audit Clearinghouse designated by the Office of Management Budget within the earlier of 30 days after the receipt of the auditor's report or 9 months after the end of the audit period. All right. So notice that these documents, the financial statements and schedule of expenditures of federal awards, the summary of schedule of prior audit findings, and the corrective action plans, all these are the responsibility of the auditee. It's only, of course, the auditor's report that is to be provided by the auditor. All right, so the required auditor's reports, what will be included there? Firstly, an opinion or a disclaimer of opinion as to whether the financial statements are presented fairly. That is, in all material respects, they are presented in accordance with the generally accepted accounting principles, and whether the schedule of expenditures of federal awards is also fairly stated. That is, in all material respects, in relation to the financial statements taken as a whole. An auditor's report will also require a report on internal control over financial reporting and compliance with federal statutes, regulations, and the terms and conditions of the federal grant, non-compliance with which could have a material effect on the financial statements. So notice that the required auditor's report in a single audit requires the report on internal control. This is why we said that single audit has a much higher level of complexity compared to the requirements of GAGAS and GAAS. Number 3, there must also be a report on compliance for each major program and on internal control over compliance. And finally, a schedule of findings and question costs. What does that mean? So the audit findings may present some sort of deficiencies and question costs. So what are deficiencies? It may be either a material weakness or a significant deficiency. A material weakness is a deficiency in internal control so that there is a possibility of material misstatement that cannot be prevented, detected, or corrected on a timely basis. A significant deficiency, on the other hand, is less severe than a material weakness, but something that needs to be brought to management's attention. Because if a significant deficiency is not taken into account or no corrective action is made, then it may progress to become a material weakness. All right. Question costs are costs that are not supported by adequate documentation. So if you spend so much, for example, in a particular expenditure and it is unreasonable, then that could be a cost that could be questioned by the auditor. Now, the schedule of findings and question costs, this is the 4th item in the auditor's report. What should it include? It should include a summary of the auditor's results, including the type of opinion rendered on the financial statements, any significant deficiencies, that's the one that we've talked about, or any material weaknesses relating to internal control, material non-compliance affecting the financial statements, major programs audited, the type of opinion and compliance for major programs, and any significant deficiencies or material weaknesses in internal control affecting the major programs, and a statement as to whether the auditee is qualified as a low risk. The findings related to the audit of the financial statements required to be reported by the Yellow Book, that is the GAGAS, should also be included in this schedule. And of course, the audit findings and question costs. All right. Let's now go to learning objective 4, the final learning objective for this topic. So here we'll discuss the special topics related to audits of government entities and not-for-profit organizations. So let's start with the special topic on single audit quality. Single audit quality has been an area of concern for decades now. The AICPA has created a governmental audit quality center to promote the importance of quality government audits and the value of such audits to the purchasers of government audit services. That means the state and local governments that are receiving federal grants in aid. The GAO, which is the General Accounting Office before 1986. From 1986 onwards, they are called the Governmental Accountability Office. So the GAO, together with the Office of Management and Budget, OMB, provide frequent updates to GAGAs and federal fund audit requirements and guidelines. So, when seeking an external auditor, governments and NFPs should prepare a formal request for proposal, RFP. So an RFP should include information about the government, and it should cover, firstly, the scope of services, that is whether it's a financial audit, a single audit, and any additional compliance audits. What else should be included in the RFP? The auditing standards to be followed. So will it be in accordance with GAS or GAGAS, or will it be in accordance with state mandated auditing standards? So an RFP should also include reports to be issued. What sort of reports will be issued? It should also include assistance to be provided to the auditor. And finally, any other considerations that both the auditor and the auditee will need to know, needs to be put into the request for proposal, because obviously this would determine the cost of the auditing service to be provided. All right, another special topic that will have an impact on auditing services to government bodies is the Sarbanes-Oxley Act of 2002, SOX in short. So the Congress response to corporate accounting scandals of the late 90s and early 2000s was the issuance of Sarbanes-Oxley's Act. You might actually ask, what are these accounting scandals? Well, there are a few, particularly at the turn of this century when we have the Enron and the WorldCom debacle. SOX, although it is actually applying to publicly held companies and their public accounting firms and other issuers, SOX have an indirect impact on government entities as well. So, whilst it applies directly to publicly held companies and their auditing firms, it also have an indirect impact on government entities as well as not-for-profits. Why? Because some states in the United States, like California is one of the big states in the United States. California have passed SOX-type regulations for not-for-profit entities. SOX, therefore, has indirectly impacted governments and NFPs, as the AICPA, the American Institute of Certified Public Accountants, have moved to align the GAS standards with those issued by the Public Company Accounting Oversight Board, PCAOB. And so, because of this indirect impact, in a sense, governments and not-for-profit entities could benefit from adopting certain requirements of SOX. So this alignment by the AICPA of the gas standards is reflected in the issuance of several new auditing standards since the enactment of SOX in 2002. SOX has really affected all entities in a sense by altering the funding status of the standard setting bodies, including the FASB and the GASB. Now, two main areas where SOX can lead to improvements in the not-for-profit governance. These two areas are the audit committees and the internal controls. So let's look at audit committees first. SOX requires audit committees of public companies. Now, what are audit committees? These are actually subsets of the board of directors. The audit committees, as required by SOX, are the ones who will appoint and oversee the auditor. They would also be in charge of resolving any disagreements between the management and the auditor, and they establish procedures to receive complaints from employees who blow the whistle on those people who are responsible for fraud. The audit committees also ensure that the auditors are independent and they are reviewing the audit report and any other written communications. So we can see here that the audit committees are actually kind of independent from the management, and so the management can't really tell the audit committee what to do, and the audit committee is the one overseeing the auditors. So a state or local government or NFP entities that establishes an audit committee will signal to the public, at least at the minimum, that the auditors report to the board that hired them are actually something that can provide assurance to the public, because the auditors report to the board that hired them, not to the management. In terms of internal controls, Section 404 of SOX requires managers of publicly traded companies to accept responsibility for the effectiveness of the entity's internal control system. So because it's the managers that are held responsible for the effectiveness of internal control system, it actually drives the managers to ensure that there is, firstly, an internal control system in place, and secondly, that this internal control system is effective. NFP managers benefit from voluntarily adopting certain requirements of the Sarbanes-Oxley Act. Some of these benefits would include the creation of an audit committee, monitoring the independence of auditors, and certification of internal controls and financial statements by the chief executive or the financial officer of the entity. Why is SOX enacted, you might ask? Well, remember the corporate scandals in the late 1990s to early 2000s? The two big ones that I have mentioned are the Enron and the WorldCom debacle. So if you just Google corporate scandals in the 90s or 2000s, you will actually find so many information. If you have a look at this website, for example, www.accounting-degree.org/scandals, you will see Enron Scandal in 2001. So what was the scandal all about? The company Enron is a Houston-based commodities, energy, and service corporation. So what actually happened? Shareholders lost $74 billion, and thousands of employees and investors lost their retirement accounts, and many employees lost their jobs. So a lot of these retirement accounts are their pension funds, all right? So who are the main players? The CEO, Jeff Skilling, and former CEO, Ken Lay. How did they do it? Well, they kept huge debts off the balance sheet. So they kind of hide it. All right. How do they get caught? Well, they were turned in by an internal whistleblower, Sharon Watkins. All right. And the penalties for these CEOs was that, well, Skilling got 24 years in prison, but Ken Lay died before serving time. So the company filed for bankruptcy. So the auditor, Arthur Anderson, was actually not independent in this case. They were helping Enron to fudge their accounts. So there's a fun fact there. Fortune magazine named Enron as America's most innovative company for 6 years in a row prior to the scandal. So awards like the Fortune magazine's America's most innovative company is not a surefire guarantee that the company will not collapse. All right. So that's Enron. What about this WorldCom? Just a year later, this WorldCom, which is a company in the telecommunications industry, also went bust. What happened? They inflated their assets by as much as $11 billion. So they were overstating their assets. And so this led to 30,000 lost jobs and $180 billion in losses for investors. The main player is the CEO, Bernie Ebbers. How did he do it? Well, he underreported line costs by capitalizing rather than expensing. So when you capitalize an expense, you're recording it as an asset. That's why the asset was overstated, inflated. All right. And so he inflated revenues and assets by faking accounting entries and capitalizing assets. So how was he caught? Well, WorldCom's internal auditing department uncovered $3.8 billion of fraud. So what's the penalty? The CFO was fired, the controller of WorldCom resigned, and the company filed for bankruptcy. The CEO, Evers, was sentenced to 25 years for fraud, conspiracy, and filing false documentations with the regulators. Another fun fact here. Within weeks of this scandal, the WorldCom scandal, the Congress passed the Sarbanes-Oxley Act. This was our special topic just now, right? So within weeks, the Congress passed SOX, introducing the most sweeping set of new business regulations since the 1930s. So as you can see, there is a whole world out there that is waiting, yes, for us to explore, but we need to be aware that there are a lot of things going on there that should really not be in the radar of Christians. And so once again, I would like to remind you of this statement by the Apostle Paul in Romans 12 verse 2. And do not be conformed to this world, but be transformed by the renewing of your mind, that you may prove what is that good and acceptable and perfect will of God. How can we renew our minds? Well, we need to be prepared. Study God's Word. Learn our craft as accountants. Because the former President of the United States, Benjamin Franklin, once said, by failing to prepare, you are preparing to fail. We do not want to fail to prepare, because I don't know about you, but I do not want to fail. The one thing that we can do to prepare is to learn our craft. That's why we are learning, and also to learn God's Word. I will leave you with that thought, and for now, I'll say goodbye until the next time we meet again. Bye for now.